Ladies and gentlemen, John here. Here's how you know we're in a new phase. People who don't know what RSI means are buying silver. Not traders, teachers, mechanics, parents, small business owners, people whose portfolio is just groceries and rent. And yes, I'm going to say something that sounds insane on purpose. Silver at $106 could happen next week. Not because of a chart, because when trust cracks, hard assets don't rise. They reprice. And that's why the one-coin strategy is spreading like wildfire. Before we go any further, quick disclaimer. This is not financial advice. This is education and market structure commentary. I'm not telling you to buy or sell anything. Do your own research and consult qualified professionals before making investment decisions. Now let's start with the simplest sentence in this entire video. Buy one silver coin. Hold it. They can't print it, hack it, or shut it off. It's history in your hands, and it doesn't require permission from anyone. That sentence is why this video will make sense. People aren't buying silver to get rich. Most people aren't buying silver because they think they're going to become wealthy. They're buying silver because they feel something in their bones. Life is getting more expensive faster than they can run. And when that happens, people don't chase returns. They chase certainty. They chase something that doesn't depend on a password, an app, a bank's approval, a platform staying online. That's why one silver coin is powerful. It's not the weight, it's not the shine, it's the principle. Here's the part that hurts, but it's true. They didn't just steal your money, they stole your time. Inflation isn't just higher prices. Inflation is stolen time. You trade hours of your life for currency. And every year, that same currency buys less of your life back. So you didn't just lose money, you lost future options, legacy, and the ability to stand still without falling behind. That's why ordinary people wake up and say, I don't want to play this game anymore. Let's use a comparison that will punch you in the gut. In 1971, $11,000 could buy a house, a car, and support a stay-at-home spouse. Today, someone can earn $50,000 and still feel like they're drowning. And the punchline is brutal. The house costs roughly 15 times more. The car costs roughly 20 times more. A single-income household becomes a mathematical impossibility. Now, I'm not claiming those exact multipliers apply to every city and every year. The point is the pattern. Paychecks moved, but life ran away. And once people feel that, they stop trusting paper promises. They start looking for hard anchors. Here's the scale that exposes the crime. Imagine spending $1 million every single day since the night Jesus was born. You still wouldn't have spent $1 trillion. That's how big a trillion is. And modern governments add trillions like it's casual. The U.S. national debt is around $38 trillion. Your brain can't feel that. But your rent can, your groceries can, your insurance can. So people don't need to understand macroeconomics to react. They only need to live. Everything changes on one hinge. August 15th, 1971. Nixon temporarily ends the gold standard. Before that date, a dollar was a claim on something finite. Government had more friction. To spend big, it had to tax or borrow under constraint. After that date, a dollar becomes a policy instrument, a promise, a story, and the printing press becomes the mother of 1,000 downstream consequences. Now, I'm not going to turn this into a political sermon. I'm going to keep it practical. When you remove the anchor, the system expands. Debt expands. Bureaucracy expands. War spending expands. Everything that requires money expands. And your purchasing power becomes the pressure release valve. You get forever war, forever bureaucracy, forever immigration pressure, forever outsourcing. You don't have to agree with every bullet, but most people feel the end result. Their effort produces less stability than it used to. And in that world, people search for something outside the promise stack. Silver fits because it's simple. You can hold it. Now we get to 3 plantations. It's harsh, but it lands because it describes lived reality. The first plantation is digital. You are the product. Your attention, data, and anxiety are harvested. Every scroll, every click, every moment of outrage or distraction is monetized by someone else. You give your time freely. They sell it to advertisers. You participate in an economy where your consciousness itself is the commodity being traded, and the terms of service change whenever they want. The platform owns the relationship. You're just renting access. The second plantation is debt, student debt, housing debt, generational debt. A man in debt is a man who is afraid. Debt changes behavior. It makes you accept jobs you hate. It makes you stay silent when you should speak. It makes you calculate every risk through the lens of payment obligations. The system prefers you in debt because debt is control. Someone who owes nothing can walk away. Someone who owes everything must stay and produce. The third plantation is tax. You work, and a huge portion is allocated before you choose anything. The money comes out before you see it, before you decide what matters to you, before you can vote with your wallet on what kind of world you want to build. The extraction happens automatically, and you're left managing what remains. Whether someone agrees with the specifics or not, the feeling is real. The system feels like extraction. And extraction makes people seek sovereignty. This is why silver matters. Because silver is one of the few exits from these systems that doesn't require anyone's permission. You don't need approval to buy it. You don't need an account to hold it. You don't need internet access to own it. It exists outside the permission structure. Now we tie it back to the title. Why could silver print $106 next week? Because in stressed markets, price moves aren't linear. They gap. And silver is one of the most violent metals when confidence wobbles and industrial demand doesn't blink. Silver is not just money. Silver is also a supply chain metal. That means when things tighten, you get two kinds of buyers. Fear buyers hedging money, and necessity buyers from industry. And necessity buyers don't wait for dips. They buy to keep the line running, so when the market gets thin and everyone wants certainty, price can jump fast. That's how you get $91 to $98 to $106 faster than people think is reasonable, not because of hype, because of rationing. Let me explain what rationing looks like in commodity markets. When a metal becomes scarce, you don't just see higher prices on a screen. You see divergence between different prices. There's the screen price, what futures contracts show. There's the premium price, what you actually pay for physical metal with immediate delivery. And there's the delivery now price, what desperate industrial buyers will pay to secure supply when their production line is at risk. In normal markets, these three prices stay close together. In stressed markets, they separate dramatically. You might see silver futures quoted at $91 on COMEX, while physical 1-ounce coins sell for $102 at dealers. Meanwhile, an automotive manufacturer needing 1,000-ounce bars for delivery next month might pay $108 to a private seller because they cannot afford a production stoppage. This is how markets transition from orderly to disorderly, not through a single dramatic crash, but through the steady breakdown of price coherence. When the different prices for the same commodity start moving independently, it signals that the financial market and the physical market have decoupled. The paper promises and the actual metal are becoming different assets with different values. Silver is particularly vulnerable to this decoupling because the ratio between paper silver and physical silver available for delivery is extreme. Estimates suggest that for every ounce of physical silver in vaults backing futures contracts, there are claims on 50 to 100 ounces through various financial instruments. This fractional reserve system works fine when everyone trusts that they can convert their paper claim to metal if needed. But when trust breaks, when people start demanding physical delivery simultaneously, the system has a problem. There isn't enough metal to satisfy all the claims. What happens then? Premiums explode. Delivery delays extend. Sellers stop quoting firm prices because they don't know if they can source the metal. Buyers panic and pay whatever is asked. The official price might show a modest increase, but in the real economy, where actual transactions occur, the price has already jumped far higher. This is how silver goes from 91 to 106 in a week, not through steady daily gains of $2, through a gap, through a morning where the market opens and everyone realizes simultaneously that the old price is no longer operative. Supply appears only at significantly higher levels, and those higher levels become the new reality before most participants even understand what happened. Now let's talk about the specific catalysts that could trigger this kind of gap move in the immediate future. These aren't speculative scenarios. These are observable pressures already building in the market. The first catalyst is inventory depletion. Visible silver stocks in exchange vaults have been declining for years. COMEX warehouse stocks, which once exceeded 400 million ounces, have fallen below 250 million. London vaults show similar drawdowns. This inventory served as a buffer. When demand spiked, additional supply could be drawn from storage. As that buffer depletes, the market loses its shock absorber. The next demand surge has nowhere to pull from except current production, which is already fully committed to existing consumers. The second catalyst is industrial delivery pressure. Major technology and automotive companies are lengthening their supply contracts and building strategic reserves. When Tesla reportedly secured 85 million ounces in January 2026, it removed more than 2 months of global mine production from the market in a single transaction. If other companies follow this pattern, and they have strong incentives to do so, the cumulative effect removes liquidity from the market. There's less silver available for spot purchase. Premiums rise. Price discovery breaks down. The third catalyst is monetary instability Every time a central bank announces additional quantitative easing, every time debt ceiling debates dominate headlines, every time inflation data exceeds expectations, a subset of investors moves capital into hard assets. Silver, as the accessible monetary metal, captures disproportionate flows from retail investors who find gold too expensive per ounce. This monetary demand adds to industrial demand, creating compound pressure on available supply. The fourth catalyst is geopolitical fragmentation. China's export controls on silver, implemented January 1, 2026, reduce the amount of metal flowing through international markets. Other nations may follow with similar measures as resource nationalism intensifies. When countries start treating silver as strategic rather than freely traded, the global market fragments into regional markets with different price levels. Arbitrage becomes difficult or impossible. Buyers in silver deficit regions must pay substantial premiums over buyers in silver surplus regions. The fifth catalyst is short covering. Silver remains one of the most heavily shorted commodities on futures exchanges. These short positions represent bets that prices will remain stable or decline. As prices rise, shorts lose money and face margin calls. To close positions, they must buy silver, which drives prices higher, triggering additional margin calls in a feedback loop. If a significant short covering cascade initiates, price moves can become parabolic in time frames measured in hours, not weeks. Any one of these catalysts could move silver prices significantly. If multiple catalysts activate simultaneously, inventory hits critical lows the same week a major industrial buyer announces emergency procurement, or geopolitical tensions escalate during a period of monetary policy uncertainty, the price impact compounds. This is how you get gap moves that seem impossible until they happen. Now let's address the psychological resistance to believing silver could move this quickly. Most people anchor their expectations to recent experience. Silver has traded in a range for years. It might move 5 or 10% in a good month. The idea of a 15 or 20% move in a week seems outlandish, but this anchoring bias ignores how markets behave during regime changes. Regime changes occur when the fundamental rules governing a market shift. For decades, silver operated in a regime where supply was adequate, industrial demand was modest and steady, and monetary demand was minimal. In that regime, prices moved incrementally. The regime that's emerging is different. Supply is constrained. Industrial demand is exploding. Monetary demand is awakening. The old rules don't apply. When regimes change, price behavior changes. Assets that were stable become volatile, relationships that were predictable break down, and moves that would have taken years in the old regime happen in weeks in the new one. This is not theory. This is how markets have always behaved during transitions. The participants who adapt to the new regime thrive. Those who insist the old patterns will continue suffer losses. Silver in 2026 is undergoing regime change. The metal's role in the economy has fundamentally altered. It's no longer a secondary industrial input with modest monetary characteristics. It's a critical enabler of technological transformation with growing monetary demand. Pricing has not caught up to this reality. When it does, the adjustment will not be gentle. Consider what $106 silver means in practical terms. For industrial consumers, it represents a doubling of costs from early 2025 levels. For solar panel manufacturers, it meaningfully affects the economics of installations. For automotive companies, it changes the bill of materials for electric vehicles. For telecommunications firms, it increases the capital required for network build-outs. These industries will not simply accept higher costs. They will fight for supply, building inventory, locking in long-term contracts, and potentially integrating backwards into mining to secure their own sources. This industrial scramble for supply security is itself a price catalyst. When major consumers shift from just-in-time procurement to strategic stockpiling, they remove large quantities of metal from circulation simultaneously. The market must clear at whatever price brings forth additional supply or reduces demand. With supply constrained by geology and mining timelines, and demand constrained by technological necessity, the clearing price must move dramatically higher. For investors and individuals holding silver, $106 represents validation. It confirms that the metal's value proposition extends beyond speculation or tradition. It proves that silver's unique combination of monetary and industrial characteristics creates genuine scarcity in a world that assumed all commodities were abundant. And it provides tangible returns that protect against the currency debasement and inflation that drove people to silver in the first place. But here's what matters more than the specific price: the principle. The reason someone buys one silver coin is not to perfectly time a move to $106. It's to opt out of a system that feels extractive and unstable. It's to hold something that exists independently of policy decisions, platform rules, and institutional approval. It's to preserve a portion of their labor and time in a form that cannot be debased or confiscated without physical force. This is why the real solution is not hoping for a savior in the White House or waiting for markets to fix themselves. The real solution is to build a parallel structure, build a lifeboat. And here's the practical list, because repetition is retention. First, buy one silver coin and hold it. They can't print it, hack it, or shut it off. It's history in your hands. This doesn't require understanding complex market dynamics. It doesn't require believing in specific price targets. It requires recognizing that physical ownership of money outside the banking system provides optionality that paper promises do not. Second, plant a garden. They can't print food independence. When supply chains stretch, when inflation makes groceries unaffordable, when distribution systems face disruptions, the ability to produce even a small portion of your own food creates resilience. This isn't doom preparation. This is practical redundancy in a system that's optimized for efficiency at the cost of robustness. Third, learn to repair. The ability to fix your own world is the ultimate rebellion. Modern consumer culture wants you dependent on specialists for everything. When you can repair your own appliances, vehicles, and home systems, you reduce costs and build capability. Skills are assets that cannot be devalued or taxed in the same way financial assets can. Fourth, build local exchange networks, trade eggs for firewood, a transaction they can't easily tax, track, or control. The formal economy runs on documentation, reporting, and intermediaries who extract fees. Local direct exchange operates outside these systems, creating value through relationships rather than institutions. This isn't tax evasion, it's community building that happens to have economic benefits. These four actions share a common characteristic. They increase sovereignty. They move you from dependence to capability, from fragility to resilience, from hoping the system works to having alternatives when it doesn't. Silver is one component of this strategy, but it's the component that preserves value across time and protects against monetary instability. Now let's return to why $106 could happen next week. Specifically, the conditions are present, inventory is low, industrial demand is high, monetary uncertainty is elevated, short positions are large, geopolitical tensions are active. Any catalyst that shifts market psychology from complacent to concerned could initiate the gap. What would such a catalyst look like? Perhaps a major electronics manufacturer announces production delays due to silver shortages. Perhaps a country implements capital controls that drive domestic citizens toward precious metals. Perhaps inflation data comes in significantly higher than expected, triggering reassessment of monetary policy. Perhaps a large financial institution faces margin calls on commodity positions and must liquidate rapidly. Perhaps a mining company reports production problems that reduce expected supply. The specific catalyst matters less than the recognition that markets currently priced for stability can transition to crisis pricing rapidly when participants lose confidence. And confidence is already fragile. Investors watching geopolitical tensions escalate, debt levels soar, and inflation persist are primed to react strongly to additional negative information. Silver, as both a safe haven and an industrial necessity, captures flows from multiple types of buyers when confidence breaks. The question is not whether silver reaches $106. The question is what price ultimately clears the market given the supply-demand imbalances that exist. 106 might be a waypoint rather than a destination. If industrial demand continues accelerating and mine supply remains constrained, the clearing price could be substantially higher. The path from current levels to that clearing price will not be smooth. It will involve gaps, volatility, and periods where price discovery breaks down entirely. This is the environment where holding physical metal provides security that paper instruments cannot match. When premiums explode and delivery delays extend, when the divergence between paper and physical becomes extreme, those holding actual coins and bars can transact at real market prices. Those holding paper claims may discover their contracts settle at prices that bear little relation to what physical silver trades for in actual transactions. The two-price world is already emerging. Dealers report that demand for physical silver coins and small bars significantly exceeds normal levels. Premiums over spot price have widened. Lead times for delivery have extended. These are early indicators that the physical market is tightening even while paper prices remain relatively contained. At some point, this divergence becomes unsustainable. The paper price jumps to reflect physical reality, or the physical market simply stops referencing paper prices altogether and operates independently. For individuals deciding whether to acquire silver now or wait, the risk calculation is straightforward. If you wait and prices remain stable, you've lost nothing except opportunity cost. If you wait and prices gap higher, you either pay significantly more or miss the move entirely. If you act now and prices decline temporarily, you hold a tangible asset with long-term value proposition intact. If you act now and prices gap higher, you've protected purchasing power and potentially generated returns. The asymmetry favors action for those who understand the fundamentals and can hold through volatility. The cost of being wrong by acting, temporary paper losses on an asset with intrinsic value, is manageable. The cost of being wrong by waiting, permanent exclusion from owning metal at accessible prices, is severe. This is not about trying to perfectly time the market. This is about recognizing regime change and positioning accordingly. The regime where silver was abundant and cheap is ending. The regime where silver is scarce and expensive is beginning. Those who understand this transition and prepare for it will navigate the coming years very differently from those who insist the old patterns will persist. Here's what I want you to understand above all else. Silver at $106 next week is not the story. The story is that people feel trapped in systems that extract value from their labor without providing corresponding security or stability. The story is that faith in institutions is eroding because institutions have failed to deliver on promises. The story is that individuals are seeking ways to preserve what they've built and protect against what they fear is coming. Silver happens to be a tool that serves this need. It's not the only tool. It's not a magic solution. But it's a tool that works because it exists outside the systems that people no longer trust. You can hold it, you can store it, you can transact with it, and nobody can inflate it, hack it, or shut it off remotely. When enough people reach for this tool simultaneously, price adjusts to reflect demand. When industrial consumers also reach for this tool because they need it for production, demand compounds. When available supply shrinks because inventory has been depleted and mining cannot respond quickly, price must rise until equilibrium is restored somehow. $106 is not the end state. It's a marker on the path toward whatever price ultimately balances supply and demand in the new regime. That price might be higher. It might take longer to reach than next week. But the direction is clear. The forces are in motion. And those who position for this reality while silver remains below $100 will look back and recognize how obvious it was that change was coming. So here's your action step. Buy 1 silver coin. Not 10. Not 100. Start with 1. Hold it in your hand. Feel the weight. Recognize that this object has value independent of any system, any institution, any promise. Recognize that this object cannot be created from nothing by policy decision. Recognize that this object will exist and retain value long after the apps, accounts, and platforms we use daily have been replaced by whatever comes next. That 1 coin is your lifeboat. It's your statement that you're opting out of the extraction game. It's your hedge against the theft of time that inflation represents. It's your alternative to placing complete faith in systems that reward insiders and externalize costs onto everyone else. And if enough people make this same decision, to hold 1 coin, to build their lifeboat, to step outside the plantation, the system that depends on extraction and dependency will find itself with less power than it thought it had. Because sovereignty is contagious, capability is contagious, resilience is contagious. When your neighbor plants a garden and you see it work, you consider planting your own. When your colleague holds silver and explains why, you reconsider your assumptions. When someone demonstrates that alternatives to total systemic dependence are possible, others follow. This is how parallel structures emerge. Not through political revolution or institutional reform, but through individual decisions that compound into collective action. 1 silver coin at a time, 1 garden planted, 1 skill learned, 1 local trade completed outside formal channels. These actions appear insignificant individually. Collectively, they represent a shift in where people place their trust and how they organize their economic lives. Silver at $106 next week is the symptom of this shift becoming visible in price. The shift itself is already happening. It's happening in the minds of people who feel the system no longer works for them. It's happening in the decisions of families choosing to build capability rather than consume convenience. It's happening in the transactions of communities creating value through direct exchange rather than institutional intermediation. The price will follow. It always does. When supply and demand reach imbalance, price adjusts. When regime change occurs, price volatility increases. When systems break, price stops moving politely. We're entering that phase. Silver at $91 today might seem expensive to those anchored to historical ranges. Silver at $106 next week will seem like opportunity missed to those who waited. Silver at $150 or $200 a year from now will seem inevitable in retrospect to those who study what's actually happening beneath surface appearances. Your job is not to predict the exact timing or price. Your job is to understand the forces at work and position accordingly, to recognize that the world is changing in fundamental ways, to accept that the tools and strategies that worked in the old regime might not work in the new one, to build resilience, capability, and sovereignty while options remain available and costs remain manageable. Buy one silver coin, hold it, understand what it represents, then decide what comes next based on your own situation, values, and assessment of risk. But do something, because doing nothing is itself a decision to remain fully exposed to systems that increasingly feel unstable and extractive. The choice is yours, the tools are available, the information is public. What happens next depends on whether people recognize the moment they're living through and act accordingly. History will not remember the exact price silver reached on any particular week. History will remember whether people saw regime change coming and prepared, or whether they insisted normalcy would continue until circumstances forced recognition. I know which group I'd rather be in. I suspect you do too, so act accordingly. Build your lifeboat. And watch what happens when the market realizes that silver's regime has changed and price must follow. If this helped you make sense of what's happening, do me a favor, hit the like button. It tells me this kind of breakdown is worth making. And I really want your take in the comments. Do you think we see $106 next week? Yes or no? One word is enough, but if you can, tell me why in one sentence. And if you don't want to miss the next update, subscribe to the Exposure Index and turn on notifications. I post fast when the market shifts, so you're not hearing about it hours later after the move is gone.